Bloomberg Audio Studios. Podcasts, radio, news.
Hello, Merryn Talks Money listeners. I just want to flag what you might have missed in Saturday's Merryn Talks Money newsletter, which now comes out every Saturday. Do sign up. It's really quite good. This week, I have written about what on earth is going on in stock markets and what you should do. Is there really a regime change underway? Do good investors recognize regime changes? How do they do that? And what do you need to do as a result? It's kind of interesting. So make sure to sign up for the newsletter. Bloomberg subscribers only. Link is in the show notes. Now, on to the show. Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I am Merryn Somerset Webb. This week, I was speaking with British billionaire Lord Michael Spencer. Michael is arguably one of the UK's most successful entrepreneurs. He's best known for ICAP, which he founded in 1986 and built into one of the world's biggest broker-dealers, putting him among the City of London's most prominent figures. It later became NEX Group, Next Group, which Spencer sold to CME Group Inc. in 2018 in a deal that valued the UK firm at £3.9 billion. In this conversation, Michael and I speak about a new venture he's passionate about, Nutshell Asset Management. Nutshell was founded in 2019. Last year, Michael increased his stake in the operating company from 25% to just over 40% and took on the role of chairman. He's also a big investor in the growth fund itself, having put in £20 million during last year, alongside a significant equity investment in the management company. He's now put £60 million into this business. So we talk about why. Why is he so confident in Nutshell strategy and so confident in Mark Ellis, who is the CEO? I also ask him about the other investment opportunities he sees at the moment and what he thinks the government needs to change to make the City of London more competitive. Hello, Michael. Thank you so much for joining us today.
Thank you. It's a pleasure to be here.
The first thing I want to talk about is this fund management business, Nutshell. So you own part of the company, you are heavily invested in the fund that the company runs, and you're chairman of it. So obviously, this is a fund management style that means quite a lot to you. So I wonder if we could start by talking about Nutshell. What is it that brought you to that?
I built my career, as you know, starting a company called ICAP, and it finished up as a very good story. But I've always followed the stock markets of the world, and really, I guess that's my passion. And in recently, traditional investing has become profoundly out of fashion as everyone wants to go towards index linking and passive management as opposed to active management. There's too much criticism of active managers taking too big a fees and not generating performance. And 4 or 5 years ago, I met Mark Ellis, who set up Nutshell. He'd been formerly a derivative trader at RBS. Although I didn't know him personally, he was quite a big client of ICAP, the firm that I then ran. And he had a very good track record as a derivative trader, but he was also, like me, passionate about the stock market and wanted to develop an analytical system that could process a lot of data over thousands of companies, not just in one market, but in a global market, to be able to access data on a huge basis, to give an analytical scoring to large numbers of thousands upon shares on a real-time basis, and to create a matrix that would score stocks that when they got to a very high score, you bought them. But even because you bought them didn't mean you then owned them forever. If they went from having a very cheap rating, so you start buying them, he also took the view that if those stocks then became expensive because the statistics had changed or the share price had changed, that you could actually sell your holding as well. So it is actually a genuine active asset manager, which has, relatively speaking, compared with many active asset managers, quite a high stock turnover of buy things when they are cheap, sell them when they become expensive, and process the data of literally tens of thousands of stocks worldwide, from Japan through to the United States, obviously the very biggest market. And the performance of his project speaks for itself to me. In the past 6 years, it has had only one down year. The up years have been generous. I mean, 35%, 4%, 25%, 26%, 27%, 5 out of those 6 years, and the down year was 22%. Over the past 3 years, Nutshell is in the top 1.5% of active funds. So it is possible, you might say, that either this is a good project or it's just a lucky project. And I watched it carefully enough to really believe that what Mark has done, what he has built here, is a superior active management system or a platform And I backed it with quite a lot of my own money, investing in the fund and also in taking an equity stake and also becoming chairman.
And when you look at the numbers so far, the fund has outperformed what I guess you would see it as its main competitors, Fundsmith, and because you had a bet within all the papers, a bet with Terry Smith that Nutshell would outperform Fundsmith, and indeed it did, and you donated £20,000 to charity as a result. Blue Whale, who we've had on the podcast in the past, and again has this quality growth bias, but one where you hold the stocks for a long time. And same, of course, with Nick Train, who also hasn't behaved particularly well recently. Blue Whale, by the way, has. But Nick Train, again, a similar kind of idea. Let's find these quality growth companies. Let's buy them when they're cheap and let's hold them until they're expensive. But over a long period of volatility, whereas what appears to be happening at Nutshell is you take that idea, buy good companies when they're cheap, sell them when they're expensive, but you do it over a much shorter time period.
And we're much more opportunistic.
Yeah, much more opportunistic. And then you have very, very high turnover. And of course, one of the things that I've written about for decades, and everyone else writes about too, is that one of the greatest killers of performance is turnover and the costs that come with turnover. So what Nutshell is doing is something that journalists, wealth managers, IFAs, etc., have been explicitly avoiding for a long time, very high turnover.
Yes, but I think there is a slight change, if I might say, in the market structure today. A lot of the Nutshell transactions are done at close of day market auctions, so there isn't a bid-offer spread. And execution commissions today are microscopic, actually, compared with what they were several years ago. And pure execution commissions are really a very low friction cost. So I think that the arguments against transaction costs are less powerful today than they were certainly a decade or 20 years ago. When I started, the stock market commission rates were more than 1%. And if the modeling outperforms that friction, we gain alpha. And hitherto, that has been the case. And I believe and hope it will continue to be.
Interesting. Well, we talk a lot about active versus passive on this podcast, and we tend to have a bit of a bias towards active. We try not to be biased, but of course we always are. And I'm very pro the idea that there will come a point when there will be a return towards active. And some of the research that we've looked at over the last couple of years has suggested to us that the genuinely active do outperform on average over most periods of time. It's just that inside what we consider to be active funds, there are an awful lot of funds that remain, to a degree, closet trackers. If you look at funds and you look at their active share, you will more often than not find that funds with a very high active share or with something else that makes them genuinely active do outperform passive.
I think that's a fair criticism, because obviously if you're running very big active funds, one thing you're terrified about doing falling anywhere, far away from your benchmark indices, and that drags you almost psychologically towards being a closet tracker. Whereas Nutshell absolutely is not in that category at all. We don't attach ourselves to any particular benchmark that we represent. We're out there just to beat the market and hopefully outperform as many of our competitors as we can. And of course, there is a sort of an interesting intellectual or mathematical contradiction here. If everyone became only invested on a passive basis, then there'd be very little discrimination about evaluating of what's the right share price for a company. Because obviously, if you're a passive fund manager, you treat everything on an equal basis and you only allocate your cash in relation to the market cap. You don't ever at any point have a discussion on whether you think Nvidia is cheap or expensive, or what are the parameters that make it worth buying or not worth buying, or for a stock like, obviously, Tesla, another interesting one.
So there comes a point when passive destroys the price discovery of the market.
It undermines it dramatically, yes. Of course it does. It means that the investors who are in passive are effectively not taking a view whatsoever about any individual stock at all. They're just saying we want market exposure. And it, to an extent, also reinforces markets when they become overvalued and undervalued. When people are all piling in because it seems like a good thing to do, you can get the extremities of bull market runs taken to ever greater heights, because momentum effect of investors piling in is exaggerated. They make no effort to ask themselves, are stocks expensive or cheap at the moment?
And is this where we are at the moment? Are we at a point perhaps with the US market where the constant inflows of passive, and again, these unquestioned flows into the US market via passive funds that's given us this situation, this incredible concentration at the top of the market, 37% of the US market, top 10 shares, etc., which we hear about all the time. Do you think this is a function of genuine quality and value, whatever the valuations may suggest, but value at the top of the market? Or is it a function, in part, of these passive flows and hence liable to severe disruption?
I think the answer is that the predominance of passive investing has been an exacerbator on market valuations. Yes, in some instances. You obviously then get into the specifics, well, which ones? And clearly, the US has undoubtedly been dramatically and phenomenally successfully dynamic in being the crucible of so many of these great companies that have emerged in the United States in the past 20 years. All the names that are familiar to us, the Magnificent Seven and many others too. And we haven't seen that really mirrored in the European markets and to a lesser extent elsewhere in the world. But yes, I do think it has probably lifted the valuations. And I'm taking personally a fairly cautious view on the markets right now. I think our valuations have been lifted to very high numbers. And obviously, we're in a complete new political paradigm with the arrival of President Trump and his approach to global trade and commercial issues, particularly his attitude toward tariffs, which I personally think are ultimately damaging to the United States as well as other countries around the world. And global trade, certainly.
Yeah, and this brings us into an environment where there's much more volatility across markets, which probably plays into the way Nutshell operates for starters. But it does mean that what they're seeing at the moment is this shift from US equities over into European equities and maybe a little into UK equities, etc. We might be at the point where this shift away from American exceptionalism, or what we have perceived as American exceptionalism, is beginning. Possibly a sort of a decade-old turning point.
I mean, to a degree, I actually think the United States does deserve a degree of credit for exceptionalism. It has been a nation that has had a wonderful culture of innovation, creativity, money making. Going to the United States, you notice that people who are very, very successful and make lots of money are widely cheered by society and as a whole, whereas that's not really true in the United Kingdom. And I think indeed, when we get to talking about the success of investing in the United Kingdom, companies that list here and entrepreneurship, this is one of the issues that separates the United States from the many countries, particularly UK and European countries, in terms of the dynamism that people want to go out there and build their own companies and become rich and famous. And that is considered a great thing in the United States, whereas in the United Kingdom, a lot of people think that if you made a lot of money, you probably made it dishonestly.
And you should certainly give it all to the government.
The government should be entitled to take ever larger amounts on it because you have very broad shoulders. And I think that is, if you are talking about the United Kingdom specifically, I think those subliminal factors matter hugely in the long run to the success of an economy, is whether we really celebrate economic success or we sniff it.
Well, let's look at the UK then, and let's look at the UK market, something, again, we talk about and write about a lot on this pod, about how can we make the UK market more attractive. And we've talked about what makes America so attractive, and we're seeing this shift in investor interest away from the US into other markets at the moment. But in the UK, things really still look quite miserable, don't they? What can we do to bring the UK back from the brink?
They are sadly bleak. And of course, the answer is this can't be sorted out in a quick period of time. It takes a whole cultural and ecosystem change. And there are several factors that need to be addressed. First and foremost, I've always found it laughable that we are the only major stock market that still has stamp duty. And as I've explained to chancellor after chancellor, if you say you're in favour of the stock market being a thriving stock market in the UK, why are we the only market in the world that has stamp duty? It's a tax on transaction. And as I said, very simply, if you have a tax on transaction, that lowers the volume of turnover. Of course it does. If you lower the volume of turnover, that means the stock is less liquid. Investors will pay a premium to have liquid stock. So what you are saying is, by force, the London market is less liquid, therefore we're going to have lower rated stocks. And they all say, well, is that really the only thing that matters? And no, it's not the only thing. But if you are not prepared to abolish stamp duty, then stop pretending that you're in favour of the London market regaining some of its global power and global reach. That is at the very beginning. That is a necessary condition. It's not a sufficient condition, but it is a totally necessary condition.
Why can't they see that, Michael? I mean, there are people involved in the industry at every level who go in constantly and say to them, it's got to go. You don't raise that much money from it. And all it does is bit by bit destroy our stock market. It would be the most wonderful signal to the world that the UK is really open to business to get rid of it. But they won't. Why?
Because they say there's no votes in this at all. All those on the left will say, we're looking after our rich friends, we're looking after the investment bankers, we're looking after the stockbrokers. We need to rediscover the narrative of actually making a long-term argument. You know what? We are, because London is an important financial centre. Financial services are our largest single generator of revenue, and we need to be efficient and compete globally. Instead of which, sadly, I think the quality of our politicians for a long time now has been that there are no votes in this. It brings in quite a few billion into the treasury, and we'll keep it because it won't make any difference next week. We'll do it in the future when things are better. It's always, let's defer this decision. And all it has meant is there's been a slow drag on the London market that no really exciting company wants to list in the UK. Klarna's not going to list in the UK. Revolut, as and when it lists, won't list in the UK. Lots of companies are now moving their listing from the UK to elsewhere. And this slow corrosion has now, it really is sad to see it. And regrettably, I think the chance of Rachel Reeves doing this is non-existent. But the Conservatives had a chance, and it's a chance they've squandered. And although I am a lifelong Conservative, that angers me considerably. And I will continue to make the argument in the case so that hopefully at some point in the not too distant future, if we're back in power, that whoever's our new leader, Prime Minister at the time, will address that. There are other things that need to be done. And the other one is the cultural issue of actually supporting the idea that listed companies and people getting wealthy is something that we want, as opposed to looking only at ways of taking their money, often by taxation. We don't celebrate our business success people nearly enough in this country. Those are the biggies that have really damaged. It's the wrong culture, the taxation of the government on corporate dividends, a stamp duty, and generally just really celebrating entrepreneurship.
So, Michael, I totally agree with you on all those things, but it's hard to row back, in that I think it would be pretty difficult politically at this point to reverse that action of Gordon Brown's, despite the fact it's one of the things that obviously we write and talk about all the time. What else could be done? There was talk before the election about a Brit ISA, but that was dumped pretty quickly. And now there's talk about cutting the cash ISA down to maybe £4,000 or £5,000 from 20 to try and encourage people to push their money into the stock market. Of course, who could know if that would be the UK stock market? And then, of course, there is discussion about mandating UK pension funds to push up the amount of money that they put into the UK market from its current kind of 4% up to maybe something more like 10. Would you be approving of any of those ideas?
I'm uncomfortable about mandatory structures. I think I would really only consider that a feasible one if the government reversed its position on the taxation of dividends. But they're not going to do that. And the ISA debate, I don't really know enough, to be honest with you. I guess it would be helpful, but it's not going to be enough. Addressing one of those issues or two of those issues is not going to reverse a sort of fundamental. The stock market used to be important in London. Now nobody really cares. And we pretend to care, but we don't really. And that is a sad and ultimately very bad thing for our economy.
So when we talk about pretending to care, let's talk about the current government and the extent to which it talks constantly about growth and how its mission is to drive economic growth in the UK. But when you look at the policies of the current government, do you see growth ahead or?
No, sadly, they have got no concept of what it takes to generate economic growth. They genuinely feel that the taxation of corporations and individuals makes little difference to economic growth. They believe the government are better at allocating resources than the private sector. And they think that We are really fine, upstanding, good, honourable, left of centre people. We can allocate the money of the country's got. We're, after all, a rich country, really, in the right direction that will bootstrap the economy upwards and generate fair, widely spread, great growth. And all they're doing is taking money away from a higher productivity part of the private sector to the public sector, where the productivity output is woeful. And the things that shocked me about the first budget was not realizing that a massive increase in national insurance on companies, by the way, would not have an impact on employment or employment decisions. A decision of such extraordinary, naivety would be a polite way of putting it, of such a degree of astonishing naivety that this would not backfire by a significant change in employment structures, which consequently mean that they backfired completely as a fundraising mechanism. On top of which, then proposing to introduce employment regulations, which on their own admission added 5 to 7 billion a year onto the cost of the corporate sector, for no other purpose really than to satisfy their trade union paymasters. So you coupled their taxation approach and allocation of resources approach and their unfriendliness towards employment, and you think, how can you possibly generate a material level of economic growth? And at the moment, our GDP growth rate, it stumbles along at 0.1, 0.2, 0.3%. By the way, our population is growing by 1% a year. So GDP per capita at the moment is shrinking. And that number will not go up on any long-term basis until they review their taxation of employment and they review the ludicrous and actually totally counterproductive employment regulations that they're proposing to implement.
Yeah. Now, you have a record of being a very strong supporter, obviously, of the Conservative Party. When you look at the current version of the Conservative Party, what policies would you support from them?
I have been a lifelong Conservative, and although I disengaged quite a lot in the past 8 years because I felt the party really drifted away from being Conservative. And it was genuinely quite true that at some points it was difficult to discriminate between Conservative policy of certain of our governments and where the opposition stood. And I felt that we were profoundly mistaken in not being prepared to make the arguments about the importance of the private sector, why welfare was costing us too much money. And the party got overly distracted. Immigration is a big issue, by the way. I absolutely accept it as a big issue. But the party got overly obsessed about immigration and absurdly, I think, about illegal immigration. Illegal immigration is 50,000 a year, not a good number, by the way. I'm not saying it is. Legal immigration was up to 900,000, and I cannot understand what the Tory party or the Tory government at the time was thinking in allowing that to happen. But we didn't do the right things economically on taxation or motivation or what it was doing about productivity in the public sector or any form of discussion about reform of the National Health Service or reform of welfare. So the Tory party was defeated, as we all know, the biggest electoral defeat ever in the history of the party last year. It wasn't a defeat that surprised me at all, to be honest with you, and we deserved it. Let's be honest, we deserved it. We've been in power for 14 years, and our record, with a few exceptions, maybe around education and a few other things, our overall performance was woeful, particularly in the past 6 years of that. And so the Tory party is now really trying to reassemble itself. And it had been guilty of a huge level of infighting over the last several years, which was not just unedifying, but also destructive in actually getting their job done. And we've got a new leader in the party, obviously, Kemi Badenoch, whom I personally support considerably. And I am looking to spend time with her, as are many others, to help her and her team without rushing to conclusions. And I think she's right to not rush to a whole feast of policy outpourings. The Tory party still has a big job to do to reestablish its credibility, its any form of dependability. I know many friends of mine who left the party in the last election, and many of them, of course, to reform. And I can't be dishonest and say I was surprised. The Tory party has a long battle ahead of it, but it is one that I have certainly re-engaged and will do my best to help provide ideas, input, and in any way that I can, but it is a long journey ahead of us.
Yeah, and you saw friends move to reform. Tempted yourself at all?
No. I'm not. Notwithstanding the recent spats in the party, I rather agree with Rupert Lowe, who said reform at the moment is effectively a protest party. And it doesn't mean to say I don't respect Farage. He's clearly a politician, has had a big impact on the whole of the political spectrum in the United Kingdom. And after all, he won remarkably well in the last election, but I still consider it's not, it is still for the Tory party to recover and re-establish their credentials, but it's not going to happen overnight. It's going to take several years, and it's a long battle.
Should we move back to what we're supposed to be talking about, to investment into companies? You said earlier that you were nervous about the market as a whole and markets being overvalued, and we were really talking about America at the time. We were talking about the American markets, which are significantly more expensive than most other global markets. There are very few markets around that are actively cheap, but almost all outside the US are knocking around historical averages rather than anything else. Where would you invest at the moment? Obviously with Nutshell, but Nutshell aside.
Listen, if I have a negative bias about the US equity markets at the moment, and I do genuinely, this is not a long-term position. I mean, the statistics are powerful. In the long run, equity investing, well executed, well selected, produces superior returns to fixed income or pretty much any other asset class. Obviously, there are periods when you get remarkable things like Bitcoin getting up to $100,000. I've never invested in crypto. If I do, make sure you sell. That
Okay.
will be.
So you're not a believer in crypto and not a believer in any crypto, even Bitcoin.
I'm not a believer in it as an investment asset. If you want to say, I quite like a flutter at the horses every now and then.
Well, we know that.
I quite enjoy going to a casino. I don't go to casinos, by the way, but I'm having a go at Bitcoin because I think that's fine. So long as you accept that this is a gambling instrument, it's not an investment instrument. As you very well know, every long-term research has shown that actually equity investing in companies that invest in growing and briefing is a better long-term way of building your pension fund or your whatever it is. So I do feel that the US market is having the froth blown off it. I mean, I think the what is happening on world tariffs is genuinely quite negative. I suspect that Trump will backtrack on that policy, but he won't do it quickly. And in the meantime, it's the whole process of what he's doing one day. One day Mexico's having 25%. Next, it's been postponed for a month, and then Canada, and then China. This provides a sort of unpredictability and disruption that makes investing by companies and or by individuals much more difficult, and therefore it is broadly not good for the global economy. And so the trade war that Trump is starting, I think, is a misjudged project, and I think it will backfire on the United States in time, and he may well reverse it, but the damage will then have been done.
One thing that you do yourself is invest in a lot of private companies and unlisted companies. And one of the concerns that many investors have had over the last decade or so is a lot of the growth now happens off market. And so once companies are listed, possibly not in the US, but nonetheless, companies are listed in a much bigger size than they used to be. And so a lot of the gains that we used to get from listed equity markets actually now come long before they're listed.
There's still plenty of good stuff out there in the listed marketplace. We, at Nutshell, I think Mark Ellis processes 10,000 companies on an ongoing basis across the globe. A portfolio is largely US, but UK, Denmark, Sweden, France, Netherlands, Canada, Norway, Germany, Taiwan. If you've got the capacity to process that, which of course, as an individual reading analyst reports, you've got no capacity to handle anything like that scale. Of course, there are good companies to look for out there. That doesn't mean to say there's not a lot of stuff that's good in private equity too.
Okay. And we're seeing a small decline in private equity assets under management globally, which is the first one for a long, long time, which I suspect is a function of rising interest rates.
Yes, rising interest rates a big component to the drive of private equity in the 90s and the early noughties.
I tell you what, why don't we finish on Nutshell, because you just mentioned it again and talked about the amount of companies that it looks at. And of course, that is one of the obvious places where AI suddenly comes into its own, right? Going through all these reports, pulling out the relevant data, making everything extremely quick. So the Nutshell, I know, operates with very few employees. And we're always looking for use cases for AI that make a real difference. And this looks like the obvious one, right?
It is. It's a pretty obvious one, absolutely. And it is a sector investing which is ripe for the correct application of AI. By the way, I do not represent myself as an expert in AI at all, but I'm sure AI would be like all those things in technology. Using it without knowing how to drive it, you've got to know how to use the information and use the system effectively to generate outcomes that are economically valuable. And so hopefully that is, well, we appear to be doing that well enough. And I think that will be one of the things that we need to make sure we can continue to do.
Well, it seems to me that we should try and get your manager, Mark Ellis, get him on as well. Talk us through some of the companies and why they're held and not held and how that works.
Yeah, I do.
Michael, thank you so much.
It's been a pleasure to do this with you. Thank you very much.
Thanks for listening to this week's Merryn Talks Money. If you like our show, rate, review, and subscribe wherever you listen to podcasts. And keep sending questions or comments to merrynmoney@bloomberg.net. You can also follow me and John on Twitter or X. I'm at MerrynSW, and John is John_Stepek. This episode was hosted by me, Merryn Somerset Webb. It was produced by Summer Sadi and Moses Andam. Sound designed by Blake Maples. And of course, very special thanks to Lord Michael Spencer.